The yuan is crashing. I'm your host, Steve Van Metre, and thanks for joining me today. And with China's economy and currency in free fall, many are starting to wonder how much longer it will be before they devalue. Let's over to Bloomberg, where we picked today's story up. This headline with China starts stealth fight back against Powell's strong dollar, as currency fixing shows the strongest bias since February 2020, as the onshore yuan has touched a fresh two-year low on Wednesday. China took steps to support the weakening yuan on Thursday after a resurgent dollar pushed the currency to a fresh two-year low. The People's Bank of China set its yuan reference rate at stronger than expected level for the managed currency, as a widening monetary policy gap with the U.S. continued to weigh. It was seen as a signal that the central bank wants to slow the pace of yuan depreciation, which has accelerated as aggressive bets on U.S. rate hikes boost the greenback. So there's a story, there's a setup that the Fed is deliberately causing the dollar to go higher. Now, as we talked about in prior shows, the Fed doesn't really have that much control over the value of dollar, but as the dollar gains strength, and the key thing we need to understand is why, it's because there's a global dollar shortage. So as the dollar goes higher in value, other currencies tied to the dollar, such as the yuan, lose value. Let's continue on, because a strong yuan fixed by the PBOC could be a warning shot to speculators who bet against the yuan in volatile times. While a weaker currency can help improve its export competitiveness, the central bank needs to guard against a snowballing effect that can aggravate market volatility and worsen imported inflation. And right now, China's issue isn't on the export side. There's plenty of demand, and we're seeing that in the global economy, for more exports and more goods. That's not their issue. The problem China's dealing with, as is everyone else, is inflation is way too high. Renewed dollar strength has created fresh headaches for Asia's central bankers, worried about the impact of capital outflows on their economies, perhaps the real story behind the story. Even South Korea has warned against currency speculation this week, as the won tumbled to a 13-year low, while the Bank of Indonesia announced measures to shore up the rupiah by bringing in foreign inflows. So again, here's part of the story: is money's leaving these economies and they don't want it. But is a strong dollar going to actually help deal with the inflation issue here in the U.S.? Absolutely. And here you can see the consumer price index in blue on a year-over-year rate change against the nominal broad U.S. dollar index in red. And we can know when the dollar gains strength. We see that here in late 2008, early 2009. Inflation comes crashing down. You see that here in 2011. Dollars gain strength, inflation coming down. Again in 2014 into 2015, dollar rally, inflation down. Happens again in 2018, happens again in 2020. And now the dollar's starting to gain steam again as the CPI rolls over, suggesting what we know is that perhaps inflation is coming down. But will it be enough to keep China's economy from crashing? Well, maybe not, as the yuan slump forces China into a balancing act to help recovery, as the currency's depreciation is seen as a policy option but poses risk. And this is important to understand, is why might they do this? Well, if you understand that as the dollar gains value and their currency weakens, what it does is it creates a lot of domestic inflation in China, and they don't want that. Now, they're used to dealing with high inflation to begin with, but when it gets way too high, that's a huge problem. So what's one easy way to fix this problem of money flowing out of your country and super high inflation? Easy. You devalue your currency, and all of a sudden, things at least start to get a little bit better. Yuan depreciation seems one last policy option left, as housing has failed to respond to policy easing, and monetary policy has fallen into a liquidity trap, which we talked about earlier last week, as loan demand is so weak. So again, maybe the only option left. A weaker currency, though, also accelerates capital outflows and market volatility, something China does not want. The more the yuan is allowed to drop, the deeper the divergence will be between the financial markets in China and the U.S., where the dollar is approaching a record high and likely to go even higher. The central bank of the world's two largest economies had already been heading in the opposite directions this year. So what we're seeing is the Fed is tightening monetary policy while China is easing. That's creating this huge divergence, leaving again China with perhaps the only option left is to devalue, and that has some interesting ramifications in itself. Few analysts expect an even steeper decline, referring to the yuan, and they say a deliberate devaluation of the kind seen in 2015 2015 that roil global markets is unlikely, although we'll see about that. Concerns over imported inflation are expected to limit the yuan's fall, while robust exports have continued to offer support. The strong dollar remains a bigger concern for many emerging economies, and it is a huge issue for many economies. And what does this mean, say, for the bond market? And I want you to understand that when a currency is weak, or in this case the yuan against the dollar, it means there's a dollar shortage. So how do you get dollars? Well, our chief strategist, Jeff Snyder, has taught us and shared with us that they tend to sell off their Treasury reserves. That puts upward pressure on interest rates. Now, what happens when you devalue, money flows back into the country, and guess what they can do? They can start building up those Treasury reserves again. So let's go back now to 2015, and look what happened to rates. And no surprise, after this devaluation that happened kind of in the summer of 2015, rates started heading lower. That wasn't just a straight line lower, but it started a path lower. And so look to that to happen as things get worse with this dollar shortage. And it's more likely than not the yuan will fall further ahead of China's all-important 20th Communist Party Congress expected later this year, when President Xi Jinping is expected to cement a third term in office. Yuan depreciation is gathering momentum, and that means markets easily could get roiled here. But one thing that shouldn't get roiled if there is a yuan devaluation is your portfolio. Put a link up here to Portfolio Shield in the corner and in the description below, because China is trying one last measure before they have to go to that ultimate nuclear option of devalue, and that's more stimulus. As China adds 1 trillion yuan more to stimulus to rescue growth. The State Council outlines 19 policies, including policy bank funds, as growth is likely to be sluggish barring major stimulus. The State Council of China's cabinet outlined a 19-point policy package on Wednesday, including another 300 billion yuan that state policy banks can invest in infrastructure projects on top of the 300 billion yuan already announced at the end of June. Local governments will be allocated 500 billion yuan of special bonds from previous unused quotas. And again, why are they doing all this? They're doing it to actually try to save the real estate market. But what if it fails? What if the dollar keeps going higher? Well, what is that probability? Well, according to one bank, it is pretty high. The surging dollar will drop next year as the U.S. slips into a recession. The Fed cuts interest rates, according to Wells Fargo, but it means more dollar pain to the upside first. The dollar will start to give up its major gains in 2023 as the U.S. economy tips into recession and the Federal Reserve is forced to cut interest rates, according to Wells Fargo analysts. The greenback has surged this year as the Fed hiked rates harder than other central banks, drawing investors in lower rate countries back towards the U.S. Doubts around the global economy have boosted the dollar, which is seen as a safe haven asset. So now all of a sudden what you're seeing here is not only demand for dollars, but the Fed is tightening. So what happens during a recession? Why do you tend to see currencies lose value? Because demand for them goes down. When the global economy is booming and people are demanding exports into the U.S. or imports into the U.S., exports from other countries, there's demand for dollars because everything is traded in dollars. But when demand goes in straight down, well, currencies tend to lose their value as well. Wells Fargo economists told clients in a note on Tuesday that they expect the dollar to continue to rise in 2022. They believe the Fed will hike rates by 75 basis points for the third time in a row in September, which is largely expected, further boosting the U.S. currency. They think the dollar could peak in the fourth quarter before entering a period of cyclical decline against other currencies. And Wells Fargo forecasts the U.S. will fall into a recession by early 2023, even as the yield curve has predicted that as well, as our chief strategist, Jeff Snyder, in addition. As inflation and rate hikes catch up with the economy, a sharp slowdown will prompt the Fed to slow its tightening of monetary policy and start cutting rates again toward the end of the year. As those rate cuts are signaled, priced, and implemented, we expect the U.S. dollar to trend lower over the course of 2023. Of course, if China doesn't devalue first, then that would make things even more interesting in terms of bringing the dollar down. But when we look at this prediction of heading into recession, does that necessarily mean a weaker dollar? Well, now we have the yield curve in blue, the 10-year Treasury minus the 2-year Treasury, or the yield curve against the nominal broad U.S. dollar index in red. And sure enough, when we see the curve come out of inversion, what happens? The dollar, it weakens. We see the curve coming out of inversion. The dollar eventually weakens. So at some point here, the curve will come out of inversion, yields will fall, and the dollar will indeed head lower. And that kind of explains why why we're seeing right now the Treasury will still remain on a rise on the bet the recovery will last longer. Many people are asking, why aren't yields falling? The answer is simple. Everybody thinks the economy is a lot stronger than it actually is and is not going to enter a recession this year or early next year. And that is putting a demand to push rates even higher under the odd belief that there is demand for loans, which, well, isn't really there. Investors mostly don't think the U.S. is in a recession, as many still believe one is inevitable as the Federal Reserve raises interest rates to bring down inflation. But many now are betting that it will take longer to get there, thanks to a run of mostly solid economic data and comments from Fed officials suggesting that they might start taking a more cautious approach to tightening monetary policy. Of course, we'll find out more from Jay Powell's speech at Jackson Hole tomorrow. But in the meantime, what does all this mean for the energy sector? Well, we have to look to our energy and materials expert, Tracy, who comments in her weekly that on Monday, the Saudi oil minister said that the oil futures disconnect may force OPEC into action. And yesterday, we saw several other OPEC nations reiterate this sentiment. Well, what does all this mean? Well, she says seasonally, we usually see a pullback in the oil markets due to natural demand declines, but this time we may actually see the opposite. If you want to know more about why Tracy thinks that, well, sign up. It's still free, so there's really no reason not to. There's a link for Markets Insider Pro in the description below, and you can get her weekly and see what she thinks of what's going on with the oil industry and everything else related to energy and materials. And now you see why that perhaps the big story is China's deval may come sooner than we think, would be bearish for the dollar and really bullish for bonds. I'm Steve Van Meter. Thanks for watching. Thanks for being fans. Bye now.